Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Things coming along, if we actually had this out, this would be coming down like this again. But this time we had $1 trillion plus in this carry trade. Just goes to the, just more investment opportunities and the size of the institutions and their confidence that this trade would continue forever. And then, of course, this little thing called the credit crunch reared its ugly head in here, and they had to do the same thing. And we saw the Japanese yen, it went up 42% this time on this move, and it's now starting back down. So the environment was very, very ripe as we went through here. All the three setups were there. But see how quickly these things change, and that's the danger of a carry trade move, and it could be the danger of this move, we think, into the BRIC countries. Things change very, very quickly in this move. So if you're in a trade like this and you're using it yourself, be very, very careful. From a standpoint of how we want to play this, we can watch these trades start to set up. Well, we know they're setting up, and we see the correlated move lately again in the emerging market asset classes, along with the Canadian and Australian dollar and commodities going up. If it starts to come over, starts to turn again, we think you're going to see a similar opportunity setups in those commodity currencies. We think right now is a perfect storm for the yen, and we're not going to see the carry trade again, or the yen really as the key driver of the carry trade going forward. And here's why. We talked about the rates starting to normalize. There's other opportunities out there. We think because of the normalization of rates, instead of all of a sudden currencies being driven by yield spread alone, and we're kind of hoping this because we think it'd be a good thing in terms of volatility in the global economy. We think you're going to start to see the currencies be evaluated more and more on the fact that the commodity, I'm just reading this note from Greg. Oh, feel free to go, Greg. The fact that currency fundamentals are going to be more of a driver in the future as interest rates normalize, and we don't see these self-driven, self-feeding liquidity moves in all these correlating asset classes. And we think that's a function of the normalization of interest rates. Also, the Japanese economy very much is in the tank. Exports are down 20-25% now, month over month. They continue to be reported. They're back in the deflationary grip that's going on in really the world economy. They really haven't emerged from the deflation that started back in the early 90s in Japan, and they're back in a big way. Debt to GDP is really off the charts in Japan relative to the other industrialized countries, and the demographics are very bad in Japan, which we think can continue to push this. So relative to the change in the what we think is the fundamentals, and really a perfect storm hitting the Japanese economy because of the structural changes going on and the lack of export component being pumped out there, we really see the yen weakening against the U.S. dollar longer term in a big way, and we don't think this trade is going to be back in play for the yen. So that's really our longer term story on the yen. Summary: global growth and liquidity. Maybe the carry trade continues. If we see the globe slow down and tightening liquidity again, we think the carry trade for a very long time is going to be dead in this cycle. So if you understand the drivers, if you know the yield, and understand your risk, you can understand the trade setups for yourself if you want to make one of these trades, or how to play it speculatively using the ISE FX options. And we'll definitely take some questions when Steve's done. Over to you, Steve.
Thank you very much, Jack. Very interesting. Let me just, oops, I got to grab the ball here. I want to thank you, Jack. I know you spent a lot of time on this presentation. You could just tell the amount of information that was here. Really, really insightful. Thank you so much. There's a lot of questions. Just wanted to show you a symbol. As Jack said, we at the IAC, we trade 6 currencies. In fact, we are soon going to be trading the Mexican peso, Swedish krona, and a New Zealand dollar. That will happen sometime late summer, I would think. Early fall, we'll be trading those. So that's neat. But right now, we just have 6. As Jack said, you could, if you believed in Jack's view, you can trade any of these using FX options. And why would you do that? Well, I like to say, in fact, all my years of trading options, just love the limited risk of options, knowing that if you put up a certain amount of money, that's all you can lose. Not saying that you want to lose that whole premium, but at least you know that if you're really, really wrong on a particular forecast, you can only lose your premium. So I took a screenshot of the dollar-yen. Those are the last couple months. And it's been sort of strange, as Jack was saying, that, here we are with dollar-yen, and the market has not changed much in the last 5 or 6 months. Very strange. Now, early last year, or actually, 18 months ago, we know they were at 120-something dollar against yen, with the carry trade pushing up the dollar so far. And then last fall, I guess we traded in the 90s or so, or maybe that was even earlier this year. Well, I guess it's on the chart there. We traded down to about 94-ish or so, and then we put in sort of a top there around 100. But we've been bouncing back and forth between 95 and 99. So if you take a look at that, if you guys like to trade options and you understand how, if you just believe that this trend was going to continue for a while, this 99 to 95 trend, well, what would you do? You could trade a bull call spread, buy the 95 call and sell the 99 or the 100 call. That would probably have been a nice strategy over the last 4 or 5 months. Now, if we think it's going to be a breakout, let's say that, Jack thinks that the dollar, U.S. dollar, is going to rally. Well, if you believe that the dollar is going to rally, you want to buy calls. And if you think that the dollar is going to be under more pressure, you're going to want to buy ISC puts. And the symbol there is YUK. And you can access the ISC FX options right through your equity options broker. So I took some August options. Nothing special about August. I wouldn't be trading in very, very short-term options, June or whatever. I obviously would want to, I could look at July, but I looked at August, but maybe even further out, into September or all the way out in December. Lots of ways to look at this. But remember, if you're bullish, you're going to be looking to buy the calls here. So you can create sort of almost a spot sort of trade here because you're risking $5.90. Now, I'm not saying you're leveraging up like you would in the spot market, but here you're almost paying parity, a little bit over, right? Because if we're trading at 96.38, you're paying 97.90, but you're going to have the ability to control the U.S. dollar relative to the Japanese yen all the way through the 3rd week in August. So that's a bullish view. The alternative would be if you were very, very bearish, you could look at buying this put for 92 cents. So these are going to be the bearish plays, the puts, and I'm talking from the perspective of buying them. Those are bearish plays. You think that the dollar is going to go lower, which means the yen's going to go higher. Now, if you feel that, as Jack does, that the dollar is going to rally, well, any of these calls might make sense to buy. Which one would you buy? Well, if you learn more about options, you'll know that there isn't any one strike price to buy. It's going to be based on your own goals and your own risk tolerances. But I wouldn't recommend, unless I was really, really, really bullish, to be buying this 27-cent option. Why? The likelihood of success is very low. The only thing I could say that's positive there is that it is a low debit. You do get a lot of leverage. And if you had a very, very bullish view that the dollar was going to rally, maybe you'd buy that option, and maybe you would just hopefully sell out of some of them as the dollar rallied.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.